What is a stock? Why do companies even sell pieces of themselves to strangers? How do prices actually move? And how do you, sitting in the US, India, or literally anywhere else in the world, actually go and buy one? In the next few minutes, I'm answering all of it. What a stock really is, why companies sell shares, how exchanges work, how you make money from it, and exactly how to start investing. Let's start with the basics. What actually is a stock? A stock, also called a share, is a tiny piece of ownership in a company. When you buy one share of a company like Apple, Tesla, or Reliance, you literally own a tiny fraction of that business. Think about it this way: if a company is split into 1 million tiny pieces and you buy just one of those pieces, you now own 1 millionth of everything that company owns, its buildings, its products, and everything. If the company grows, makes more profit, and becomes more valuable, your tiny piece becomes more valuable too. That's it. You're not gambling, you're not betting, you are buying ownership. But why would a company even sell pieces of itself to strangers? Because companies need money to grow, to build factories, hire people, develop new products. If a company borrows from a bank, it has to pay that money back with interest every single month for years. That debt sits on the company like a weight, whether the business does well or not. But there's another option. Instead of borrowing money, a company can sell shares to the public one time through something called an IPO, an initial public offering. In exchange, thousands, sometimes millions, of regular people like you and me become part owners. The company gets cash to grow, you get a piece of their future. Now, once a company sells those shares, where do people actually buy and sell them? On a stock exchange. In the United States, the two biggest are the New York Stock Exchange, the NYSE, and the Nasdaq. In India, it's the BSE and the NSE. In the UK, the London Stock Exchange. In Japan, the Tokyo Stock Exchange. Almost every country has its own exchange, running independently, yet somehow all connected to the same global financial system. Think of an exchange like a massive digital marketplace, except instead of buying vegetables or furniture, people are buying and selling tiny pieces of companies every single second of every trading day. Millions of buyers and sellers all typing in orders at the same moment, and the exchange is what matches them together instantly. But here's the part most people never think about. For every single share that gets bought, someone else has to be selling it. There is no trade without both sides agreeing. If you want to buy a share of Apple at a certain price, the exchange has to find someone who is willing to sell their share of Apple at that exact same price, at that exact same moment. No matching seller, no trade happens. The price simply sits there, waiting, until a buyer and a seller finally agree. Now, here's where it gets interesting. Say a seller is willing to sell their share for $110 and a buyer accepts. The trade happens. The price is now 110. But the very next seller, they are not willing to let go for 110 anymore. They want 115. And this time, a buyer accepts that price too. Just like that, the stock price has moved from 110 to 115. That's it. That's literally what demand means in the stock market. More buyers willing to pay higher and higher prices. Simple. Supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. And what drives that demand? Company earnings, news, economic data, interest rates, even pure emotion, fear and greed. Now you might be wondering, how is this different from just buying gold or a house or crypto? Stocks are unique because they represent a piece of a real operating business. Gold doesn't generate profit. A house needs maintenance and doesn't scale. But a great company can grow its profits year after year. And that growth gets reflected directly in your shares. Okay, let's get practical. How does someone in the United States actually start? Step 1. Open a brokerage account. So what exactly is a brokerage account? Think of it like a bank account, except instead of just holding cash, it lets that cash buy pieces of companies. Quick clarification, because people mix these up all the time. What's the difference between a stock exchange and a broker? The stock exchange, NYSE, Nasdaq, BSE, NSE, is the actual marketplace. It's where buying and selling physically happens, where buyers get matched with sellers, and where the official price gets set. But here's the catch: you can't just call up the NYSE and place an order yourself. It doesn't deal with individual people directly. That's where the broker comes in. A broker, like Fidelity, Zerodha, or Robinhood, is the middleman between you and the exchange. When you hit buy on the app, your broker is the one actually sending that order to the exchange on your behalf. They hold your money, hold your shares, and give you the platform to trade from. Every countries have different brokers. For example, in United States, platforms like Fidelity, Robinhood, or Webull are there. It takes just minutes to set up. Step 2. Link your bank account and transfer money in. Step 3. Decide what you're buying: individual stocks or something safer like an index fund or ETF that holds hundreds of companies at once. Many Americans start with something called the S&P 500, an index fund that tracks the 500 biggest companies in America. One single purchase, 500 companies, instant diversification. And this pattern repeats almost everywhere in the world. So once you own a stock, how do you actually make money from it? There are two ways, just two. Number one, capital appreciation. This simply means the value of your share goes up over time. Say you buy one share of a company for $100. The company grows, becomes more profitable, more people want in, and a few years later, that same share is worth $300. You sell it and you walk away with the profit. That's capital appreciation. Number two, dividends. Some companies don't just grow in value, they also share a portion of their actual profits directly with shareholders, simply for owning the stock. No selling required, no timing the market. The company literally deposits cash straight into your account, often every quarter, like clockwork. So you could own a stock for 10 years, never sell a single share, and still be getting paid the entire time just for holding it. Now, some investors chase growth, picking companies they believe will explode in value. Others chase dividend. But the smartest investors, they build a mix of both: growth for the future and dividends for cash flow right now. But let's be honest, the stock market isn't a guaranteed money machine. Prices can drop, companies can underperform, entire markets can crash. Sometimes it's gradual, a slow decline over months. But sometimes it's sudden, out of nowhere. There's actually a term for this: a black swan event. Something so rare, so unpredictable, that almost nobody sees it coming. Think 2008, the global financial crisis, or 2020, when COVID shut down. Markets dropped 30 to 40% in a matter of days. This is exactly why diversification matters. Never put all your money into one stock, one industry, or even one country. Spread it across industries, countries, and asset types. So buy during the crash because stocks are cheap sounds smart. But in real time, you have no way of knowing if you're buying at the bottom or buying right before it falls another 30%. The investors who actually win long term aren't the ones trying to guess when the crash is coming. They are the ones who stay invested through it. Because historically, markets that crash eventually recover and go on to reach new highs. Some people call compounding the eighth wonder of the world. A small, consistent investment. Doesn't look like much in year one, but compounded over 20, 30, 40 years, consistent investment turns into massive wealth. So in the upcoming videos, I'm going to teach you exactly how to do fundamental analysis on any stock, step by step, so you can analyze for yourself whether a company is actually worth investing in.